Ever wonder why so many traders seem to make the worst decisions at the worst possible times? They panic and sell at the bottom, and then buy when everything looks like it's about to crash. It's a cycle that repeats itself again and again, and today we're going to break down why this happens and, more importantly, how to avoid it. If you've ever been caught in the emotional whirlwind of the market, you know the feeling all too well. It's one thing to understand the theory behind buying low and selling high, but it's a whole different story when fear and greed start calling the shots. In this video, we're diving deep into why so many traders fall into the trap of buying at the top and selling at the bottom, why it happens so frequently, and what you can do to avoid these costly mistakes. By the end of this video, you'll understand the psychology behind these market missteps, the emotional triggers that lead to bad decisions, and how you can stay one step ahead of the crowd to make smarter, more calculated moves. Let's start with the most common culprit, the fear of missing out, or FOMO. It's easy to see why people buy at the top. Just look at those numbers. The market is booming, everyone's talking about it, and you don't want to feel left out. It's the classic, everyone else is getting rich, so I have to jump in now moment. The thing is, when everyone is buying, prices are inflated. You're getting in when the market is overheated. And as soon as the momentum slows down, what happens? The price starts to drop, and that's when panic sets in. Has this ever happened to you? Let me know in the comments if you've jumped in at the peak of a hype cycle and regretted it later. Now let's talk about why people sell at the bottom. It's not just about bad luck, it's about panic. When the market drops and your investment starts losing value, fear takes over. The what-if thoughts creep in. What if it keeps going down? What if I lose everything? In moments of fear, people often make the worst decisions. They sell out of panic, thinking they can't afford to lose anymore. The problem? They're selling when the market is low, missing out on the eventual rebound. Have you ever sold in a panic? What was going through your mind? Share your experience below. I'd love to hear from you. Here's where it gets tricky. The psychological cycle. People often buy high and sell low because they're driven by emotions instead of logic. This creates a vicious cycle. After buying at the peak, they hold on in hopes of a rebound, but as the price keeps falling, their anxiety grows. Eventually, they sell to cut losses. But here's the catch. When they sell, that's when the market starts to recover, and they miss the bounce. By the time they realize they should buy back in, the price has already risen. They're stuck buying at higher prices, continuing the cycle of buying high and selling low. Let's talk about trading strategies now. A lot of traders fall into this trap because they don't have a clear strategy in place. Day traders, swing traders, value investors, all these different approaches can help protect you from emotional decision-making. For instance, if you're day trading, you're focusing on short-term moves, and you might be more susceptible to sudden market swings that trigger fear and greed. But having a clear set of technical indicators can help you avoid the emotional roller coaster. With swing trading, you're looking at medium-term trends, so you're less likely to panic during daily fluctuations. Value investors are looking for long-term growth, which means they're much less likely to get caught up in hype or crashes as they're looking at the bigger picture. No matter what type of trader you are, a well-defined strategy is key to preventing these emotional decisions. You need rules for when to buy, when to sell, and when to step back. Now here's something that a lot of traders don't consider: psychology. When we talk about the emotions behind bad trading decisions, it's important to understand biases like loss aversion. This is the psychological concept where the pain of losing money feels worse than the joy of gaining it. This leads people to sell at the bottom because they're more focused on avoiding further loss than recognizing a potential recovery. Similarly, confirmation bias is when traders only pay attention to news or information that supports their preconceived beliefs. This often leads to ignoring red flags that suggest a market correction is coming. Traders will buy into a rally because they're convinced it's going to continue, only to sell out at a loss when the market corrects itself. We also can't ignore herd mentality. Humans are social creatures, and we tend to follow the crowd, especially in moments of crisis. If everyone's panicking, it's hard to resist that urge to follow them, even if it's not in your best interest. This is a big reason why people sell when the market drops. Everyone else is doing it, so it must be the right move, right? Let's bring this back to real-world examples. The 2008 financial crisis is a classic case of panic selling. At the peak of the market, people were buying real estate at inflated prices, driven by fear of missing out on the next big thing. When the market crashed, millions of people panicked and sold their homes at a massive loss, further fueling the downturn. Another example is the dot-com bubble. In the late 1990s, tech stocks were soaring and people were jumping in, convinced they were going to make a fortune. As soon as the market started to show signs of slowing down, panic spread. Investors sold off in droves, causing even more damage to the market. Have you seen something similar happen in your trading experience? What were the emotions you felt when the market was at its peak, and how did you react when it crashed? Let me know in the comments. At this point, you might be wondering, how can I avoid falling into this emotional trap? The first thing you need is a solid plan. Set clear rules for yourself. When will you sell? When will you buy? And stick to that plan. Trust the process and don't let emotion take over. A great tool for staying on track is automatic stop-loss orders. This is when you set a limit on how much you're willing to lose on a trade. That way, you don't have to make decisions under pressure when the market drops. The stop-loss order will sell your position automatically at a predetermined price. Journaling your trades can also help. By writing down why you bought or sold a stock, what you were thinking at the time, and how the market was behaving, you'll start to see patterns in your decision-making. This can help you recognize emotional triggers and avoid them in the future. Lastly, diversify your portfolio. When you have a mix of investments, it reduces the pressure to make a big win or avoid a big loss. If one asset drops in value, the others can balance it out, which helps keep your emotions in check. Before we wrap up, I want to know, what's your strategy for handling market fluctuations? Do you stick to a plan, or are you guilty of sometimes buying at the top and selling at the bottom? Drop a comment below and let's talk about it. So there you have it, the psychology behind why so many traders buy at the top and sell at the bottom. It's not just about bad luck, it's about emotions taking control. But with a clear plan, the right mindset, and a little patience, you can avoid the common pitfalls and come out on top. If you want to learn more about trading strategies, market psychology, and how to stay ahead of the crowd, make sure to subscribe and hit that notification bell. And don't forget to comment below with your thoughts. I read every single one. Thanks for watching, and I'll see you in the next one.